Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in China. At the start of the COVID pandemic in 2020, China introduced strict lockdown restrictions, and these restrictions stayed in place until December 2022. And those 3 years of restrictions and the associated lockdowns had a negative impact on the economy of China. The restrictions were finally lifted in December 2022, and the first quarter of 2023 represented a period of strong growth for the Chinese economy. However, the figures for April 2023 indicate that recovery is now slowing down significantly, and there are now major concerns about the outlook for the rest of 2023 for China. So in today's video, I'll go through the latest import and export figures for China, which are two of the major areas of concern. We'll have a look at what's happening with industrial production, retail sales, property investment, and as you'll know if you follow the channel, property has been one of the biggest drivers of the Chinese economy over the course of the last 20 years. However, over the last couple of years, we have seen a nosedive in that sector. The massive property development companies such as Evergrande that were building cities all over China suddenly found that they couldn't access any of the debt facilities, and that sent those businesses into a tailspin, brought down property prices, and more importantly, China's appetite to buy property, and that's had a really negative impact on the Chinese economy. We'll have a look at the latest position with regards to the amount of loans that have been drawn down. We'll look at what's happening with inflation. And remarkably, compared to the rest of the world, China is actually experiencing deflation at the moment. So its prices are going down. So we'll talk through what the implications of that are for the Chinese economy. I'll share with you some really interesting figures with regards to the jobless rate amongst younger employees. And then finally today, I'll wrap up with my summary. So what I think is likely to happen for the Chinese economy over the course of the next 3 to 6 months, and what the impact of this will be on the global economy.
China's latest trade numbers are casting a shadow over growth hopes at home and abroad. Imports unexpectedly fell almost 8% in April. That was far worse than economists expected and extended a fall seen the month before. Exports grew 8.5%, or little more than half the surge recorded in March. The weak numbers come despite the lifting of health crisis restrictions, and they will raise concern worldwide, as the import numbers mean the global economy may not be able to rely on China to drive demand. That's already showing up in other numbers, such as a drop of more than a quarter in South Korea's shipments to the country. The cooling export numbers also suggest tepid demand for Chinese products overseas. Beijing officials have repeatedly warned of a severe and complicated external environment amid recession risks for many key trading partners. Analysts say rising rates and the recent banking turmoil are among factors limiting demand in Western markets.
This chart shows the year-on-year percentage movement in imports and exports for China dating back to April 2021. The dark blue line in this chart plots what's been happening with imports, and the light blue line exports. And the scale on the left-hand side of this chart goes from minus 20% to plus 40%. Imports fell by 7.9% year on year, which extended the 1.4% decline seen in March. And these figures are a direct result of weak domestic demand. And if we take a step back and look at the trend over the last 2 years, you can see that it's highly negative. In April 2021, as China was coming out of the first wave of lockdowns, imports were increasing by more than 40%. Between April 21 and April 22, China saw a steady reduction in that growth in imports. And over the course of the last 12 months, the level of imports has actually fallen. It's moved into negative territory on this chart. And that fall in imports is highly concerning for two reasons. Firstly, it reflects reduced consumer demand within China. They're buying less things in. But more importantly, it shows a slowdown in Chinese manufacturing, because China is importing large amounts of raw materials, which it uses for its manufacturing processes. So the fact that there's been a reduction in those purchases means that it will be producing less, and therefore that will have a direct negative impact on the Chinese economy, because they will be producing less, selling less, and their GDP will be impacted. If we now look at the situation for exports, you can see that exports grew by 8.5% in April. However, that level of growth represented a sharp fall against the 14.8% increase seen in March. And the major concerns here are that firstly, when you compare what's happening in April this year to April last year, April 2022 was a particularly weak period. A lot of lockdowns have been introduced in China, and that had a negative impact on the level of exports at that time. So on a year-on-year basis, the April 23 figures are being compared with a comparatively low figure. So 8.5% growth in that context doesn't represent stellar growth. And when you combine that analysis with what's happening with imports and also all the manufacturing data that we're going to come onto in a moment, it's raising major concerns for the Chinese economy. And once again, if we take a step back and look at what's been happening over the course of the last 2 years, you can see that in April 21, export growth was around 30% positive. However, in the 12 months to April 22, there was a consistent decline in the level of growth. There was actually a bounce back in export growth between April and July 22. However, since August, we've seen a decline in the level of growth. And between October 22 and February 23, there was actually a decline in the level of exports. We saw a bounce back in quarter 1 of 23. However, that bounce back now looks like an anomaly. Now, before we go on any further today, I want to talk to you about today's sponsor, Atlas VPN, and to let you know about their amazing 3-year deal whereby you can get full coverage for only $1.83 per month, including an additional 3 months extra and a no-risk 30-day money-back guarantee. If you use the internet without any form of protection, you leave yourself exposed to tracking, hacking, and advertising. Using Atlas VPN protects you from all of these. Atlas VPN provides you with comprehensive security and is used by more than 6 million people worldwide. So it's fantastic news that it will protect you from hacking and tracking and data breaches. But what's also great news is that it can save you money and open up a whole new world of entertainment, because it allows you to change your location, which gives you the opportunity to get better deals and to access content that may not be available in your region. Atlas VPN is available to use on unlimited devices for one subscription, and Atlas VPN is currently offering an amazing 3-year deal whereby you can get full coverage for only $1.83 per month, including an additional 3 months extra and a no-risk 30-day money-back guarantee. So to purchase this exclusive Joe Blogs offer, please click in the description below. This chart shows the year-on-year percentage movement in industrial production in China. And as I mentioned at the start of the video, industrial production is the heartbeat of the Chinese economy. China is the biggest supplier of manufactured goods in the world, and as a result, this metric gives us a very good steer as to what's happening in the Chinese economy. And as you can see from this chart, over the course of the last 12 months, China has achieved positive growth in industrial production in every single month. And in April 2023, industrial production increased by 5.6%, which was a positive movement against the 3.9% seen in March and the 2.4% seen in February. And over the course of the last 12 months, 5.6% is actually the second highest growth rate. So at face value, you may be thinking that these figures show that China is doing really well. However, unfortunately, in order to achieve the targeted level of growth for China, it needs to be hitting far better figures than this. And the forecast level of growth for April 23 was actually 10.9%. So 5.6% represents a shortfall of 5.3%. This chart shows the movement in the Manufacturing Purchasing Managers Index over the course of the last 12 months. Now, if you're a regular viewer of the channel, you'll know that we've looked at the Purchasing Managers Index a number of times, and this is a globally recognized index that's put together using data provided by purchasing managers from key industries all across the world, and it shows whether those manufacturing businesses are expanding or contracting. Now, the scale on the right-hand side of this chart is an index, and it goes from 48 to 52, and the key figure when looking at this index is 50. A score above 50 indicates that the manufacturing business is expanding, whereas a score below 50 indicates that it's contracting. And as you can see, in April 23, the index for China was 49.5%, which is obviously below 50% and therefore indicates that Chinese manufacturing is contracting. And if we look at the trend as to what's been happening in 2023, you can see that in January, the index was below 50. However, in February, it surged to more than 51.5%, which indicated that there was strong growth in the Chinese manufacturing sector. But unfortunately, that growth was short-lived, and we saw the index fall back to 50% in March and has now fallen further again. And if we look back to the start of this year, you can see that what's happening right now is an exact repeat of the pattern that we saw in May, June, July, August, and September. And as you can see, in September, the index fell to just above 48%. So the concern now is that the figures for May may be considerably worse. This chart shows the movement in retail sales in China over the course of the last 12 months. And this chart really highlights the ups and downs that the Chinese economy has been experiencing. This time last year, retail sales fell 6.7%. Retail sales growth then bounced back into positive territory, achieving 3.1% growth in June, 2.7% in July, 5.4% in August, and 2.5% in September. Retail sales then fell 0.5% in October, 5.9% in November, and 1.8% in December. And really what we're looking at here is the direct impact of the continued lockdowns that the Chinese authorities were still introducing during 2022. Now, as I mentioned at the start of the video, in December 22, the Chinese authorities announced that they were removing all of the lockdown restrictions. And as a result of that, China has seen a strong bounce back in retail sales, achieving 3.5% growth in February, 10.6% in March, and 18.4% in April. So once again, you may be thinking that this actually shows the Chinese economy is doing really well. But unfortunately, the expectation for retail sales in April was 21% growth. So the actual figure represents a shortfall of almost 3%. And the growth figure of 18.4% is actually a bit misleading, because if we expand the graph out to show the 5-year position, you can see that in April 22, retail sales fell by 15%. So when you're comparing on a year-on-year basis, the 18.4% for April 23 is being compared with an extremely low figure for April 22, which means that the absolute level of retail sales is not actually as high as first indicated. And of course, one of the reasons that retail sales is such an important indicator is that it shows what's happening with consumer demand in China. And as the population of China is more than 1.4 billion people, that represents a lot of global purchasing power. This chart shows the movement in the consumer price index and the producer price index in China dating back to January 2021. The scale on the left-hand side of this chart ranges from -5% at the bottom to +10% at the top, and the dotted red line you can see across the middle of this chart represents the government's target inflation rate of 2.5%. The blue line at the top of this chart represents the producer price index, which is also known as the factory gate price. And this is plotting the price of products that companies in China are manufacturing. So it's measuring whether or not the prices are going up or going down. And the red line on this chart represents the consumer price index, which is basically the rate of inflation. So this is the basket of goods that's measured on a monthly basis, comparing the price of those goods to see whether or not prices are going up or going down. So if we start off by looking at consumer price index, or the inflation rate first, you can see that back in January 21, the rate of inflation was actually below zero. So China was experiencing deflation. Prices were actually going down. And over the course of the last 2 years, the rate of inflation hasn't actually ever hit the target rate of 2.5%. So that means that China has seen very little in the way of inflation. On average, prices have been rising by 1 or 2%. Which is obviously in direct contrast to what's been happening in the rest of the world. Following the ending of COVID-19 restrictions at the end of 2020 in most countries, we saw a surge in consumer demand, which drove up prices. And in many economies, we saw inflation rising above 10%. And for the majority of governments and central banks, bringing down the rate of inflation has been their number one objective. And as a result of that, we have seen a rapid rise in interest rates. But none of that has affected China. Because of the prolonged period of COVID-19 restrictions, China didn't have this huge bounce back and surge in demand that we saw in a lot of other economies. And if we look at what's been happening over the course of the last 6 months, you can see that inflation has fallen from around 2% to the current annual rate of 0.1%. So basically, there's been no movement in prices in China over the course of the last 12 months. Now, in view of all of the furore and conversations that people have been having about rising inflation over the course of the last 2 years, you may be thinking that 0% inflation sounds pretty good, that if prices are the same as they were this time last year, that's quite a good thing from a consumer point of view. But the problem that China has is that its whole economy is based on manufacturing. So it needs all of its industry to be making more profit in order for the economy to grow. And for the vast majority of businesses, they want to see year-on-year increases in their prices because generally speaking, their costs are going up. And so you need to pass on your increased costs into increased prices. So this is why a lot of governments have a target rate of inflation of around 2%. They want to see some healthy growth in prices. They don't want prices to remain flat and stagnant because it will mean that a lot of companies whose costs are rising will be making less profit if they can't sell their products at a higher price. And that is exactly what's happening in China right now. Prices have flatlined and therefore companies are making less profit. There is real pressure on their margins. If we now look at what's happened to the producer price index, during 2021 there was a rapid increase in producer prices, moving from around 0% at the start of the year to almost 15% by the end of the year. However, during 2022, we saw a complete reversal of that trend. And over the course of that year, prices moved from a positive increase of 15% to a fall of around 1%. And this is really bad news for the Chinese economy, because the reason that factory gate prices were coming down wasn't because costs were coming down. In fact, in 2022, the price of raw materials rose dramatically in the international markets. Following Russia's invasion of Ukraine, we saw a huge spike in the price of oil and gas and coal and other commodities. So prices actually increased. But China was reducing its factory gate prices in order to remain competitive and try to achieve a higher level of sales. And if we look at the situation for April, you can see that year on year, factory gate prices have fallen by 3.6%. So the selling price for goods that China is manufacturing is now 3.6% lower than it was this time last year. However, the costs have gone up, and that means that those companies are making less profit. And when you apply that across the whole economy, that is going to be really bad news for China. Investment in the property sector, a key pillar of the Chinese economy, tumbled 16.2% year on year in April, after a 7.2% drop in March, as investors remain cautious on the property sector. And this chart shows the year-on-year movement in newly built house prices in China over the last 5 years. And the reason that this metric is important is that the Chinese property market is dominated by newly built properties. The vast majority of all property purchases are new build, the majority of which are purchased off-plan, so people are buying them before they're actually constructed. And what this chart shows is that property prices are still falling month on month. And this is a reflection of the fact that Chinese consumers have lost confidence in the property sector. If we look back at the situation over the last 5 years, you can see that in 2018, property prices were increasing by around 5%. However, between 2018 and the first half of 2019, the rate of increase actually got above 10%. However, at that point, the Chinese authorities brought in what was known as the 3 red lines, and these were regulations that were introduced to stop the Chinese property developers becoming over-leveraged, taking on too much debt. But unfortunately for a lot of those companies, they'd already gone past the point of no return, with the most famous example being Evergrande, that had built up over $300 billion of debt, which is a mind-bending amount of debt. And this chart shows a graphical representation of the impact of that policy on the Chinese property sector. Because they could no longer access large amounts of debt, the Chinese property developers actually had to slow down their rate of build. And this meant that a lot of properties were not finished that people had already paid for. And that started to have a direct impact on consumer confidence in property prices. And over the course of the last 4 years, we have seen the rate of growth in property prices coming down. And during the second half of 2022, we actually started to see prices falling. And because around 25% of the Chinese economy is dependent upon the property sector, that's had a negative impact on the Chinese economy itself. This chart shows the amount of new loans being provided in Chinese yuan over the course of the last 12 months. And it shows that the total amount of new loans provided in April was just under 719 Chinese yuan, which equates to around $100 billion US. And this represented a fall of almost 82% against the new loans provided in March, and is the lowest figure that China has seen since October 2022. And there are 2 reasons why the level of new loans is really important. Firstly, from a business point of view, a lot of Chinese manufacturing businesses need to borrow in order to buy in their raw materials and pay for all of the production. So a fall in the level of lending indicates a slowdown in the level of manufacturing business. And secondly, the property market is financed predominantly through lending. So a fall in the level of mortgage lending indicates that there's less demand for property, and therefore there's a further slowdown in the property sector. And as we discussed earlier in the video, the property sector equates to around 25% of the Chinese economy. So both of these factors will have a negative impact on China's growth. So what's the summary and conclusion today? Well, I wanted to post this video really to give you an update as to what's happening in the Chinese economy, because reports in the mainstream media over the course of the last few months is that since the COVID-19 restrictions were released, China is bouncing back, it's coming back to full health. It had a very first strong quarter in 2023, and the expectation was that that was going to continue and that growth would fuel the growth in the global economy and that we could avoid a recession in 2023. However, what we've talked about in today's video is that the figures for April represent a sharp deterioration against where the market expected China to be at this point in the year. China did achieve positive growth in industrial production in the month. However, that growth was around 50% of what the market was expecting. And when you look at what's happening with exports, we saw a sharp decline in the growth of exports in April. And the longer term trend over the last 2 years indicates that we're likely to see a further weakening in exports. And when you look at what's happening with imports, we actually saw a 7.9% fall in the value of imports during the month. And that is really bad news because China is importing a lot of raw materials, which it then uses in its manufacturing process to produce finished goods. So if China is importing less raw materials, that means that it's going to be manufacturing less. And that will therefore have a knock-on impact to the level of exports and sales over the course of the next 3 to 6 months. Retail sales in April actually increased by 18%. However, that was also short of market expectations and compared against very weak figures for April 2022. So again, this indicates that consumer demand in China isn't bouncing back to the level that everybody's expecting, and therefore there is a major question mark as to whether or not China will be able to achieve its forecast levels of growth. And I think one of the biggest concerns with regards to future growth is what's happening with regards to loans. The level of new loans provided in April represented a fall of more than 80% against the figures from March, and were the lowest figures seen for the last 6 months. And the reason that this is important is that loans are fueling both the growth of the manufacturing sector and also what's happening in the property sector. And the property sector has been absolutely key to China's growth over the course of the last 25 years. The property sector is a huge employer in China and historically has represented around 25% of China's GDP. So now that we're seeing a slowdown in the level of new loans, we've seen a downturn in the property sector, we've seen falling prices in the property sector, and that means that we're seeing a significant slowdown in one of the biggest sectors in the Chinese economy. And another main area of concern is what's happening with the level of youth employment. Young people who are coming out of education and looking for employment. And the unemployment rate for people aged between 16 and 24 has hit a new all-time high in April 23 of 20.4%, which means that 1 in 5 young people don't have a job in China. And for a country with a population of more than 1.4 billion people, that is now starting to see its numbers decline. So it's got an aging population. This is a major concern because if those young people can't get into employment, then that's going to cause major problems further down the road. And then the final issue that's causing concern is what's happening with inflation and producer prices. And as we saw from the data that we looked at, inflation is now virtually at 0% in China. So manufacturers are not able to increase their prices. And in fact, what we've seen is that manufacturers are now dropping their prices. Year on year, there's been a 3.6% fall in factory gate prices. And that is going to hurt all of those companies because they're earning less money now than they were this time last year because they're having to cut their prices. But costs aren't falling. So that means that they'll be making less profit and contributing less to the Chinese economy. So the overall summary of our assessment of the Chinese economy is that things have really started to slow down in April. And if this trend continues, the outlook for the rest of 2023 is going to be a lot lower than originally expected. Now, China is a growth economy, so it's unlikely that we will see China going into a recession. We won't see a fall in GDP. But what looks likely right now is that the expected levels of growth will be far lower. And that is essentially the same thing as having a recession, albeit the figures won't be in negative territory. So that obviously represents bad news for China, but what's the impact on the global economy? Well, as I mentioned at the start of the video, China is the second largest economy in the world, and GDP for 2022 was estimated to be around $18.5 trillion. which is around $6 trillion less than the USA. However, it was around $13 trillion higher than the next largest economy, which was Japan, which recorded GDP of around $5.3 trillion. So in the context of the global economy, China is absolutely huge. It has a really big impact. China is a net exporter, so it's selling more goods than it's buying, but it's still buying in huge volumes. So a slowdown in the Chinese economy is going to have a really big impact on the global economy because China will be buying less goods and raw materials from the rest of the world, and that therefore represents a fall in income for all of the other countries. So if we do see the Chinese economy considerably slowing down during the course of 2023, it's likely that it will drag the global economy with it, and we will see a slowdown in the global economy. And if you follow the channel, that news will not be a surprise to you because I've said a million times before that the whole world is interconnected. So what's happening in China will have an impact on every single country in the world. So hopefully you've enjoyed today's video, you found it useful, interesting and thought-provoking. If you've liked what I've said, please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.